Hello, everyone. Welcome to this video where we will talk about the main message of the book Rich Dad, Poor Dad by Robert Kiyosaki. This book is a bestseller that has sold over 32 million copies worldwide and has been translated into 51 languages. But what is this book about? And why should you read it? Well, this book is not just about money. It is about how to think about money, how to use money, and how to become financially free. The book teaches you the difference between the poor, the middle class, and the rich, and how you can change your mindset and habits to join the rich. The book is based on the author's own life story. He had two fathers, his biological father, who was a well-educated and hardworking employee, but always struggled with money, and his best friend's father, who was a successful businessman and investor, and became one of the richest men in Hawaii. The author calls them his poor dad and his rich dad, respectively. The book is divided into 6 lessons that the author learned from his rich dad. These lessons are: Lesson 1. The rich don't work for money. Lesson 2. Why teach financial literacy? Lesson 3. Mind your own business. Lesson 4. The history of taxes and the power of corporations. Lesson 5. The rich invent money. Lesson 6. Work to learn. Don't work for money. Let's briefly go over each lesson and see what we can learn from them. Lesson 1. The rich don't work for money. The first lesson is that the rich don't work for money. They make money work for them. What does that mean? It means that the rich don't depend on a paycheck or a salary to earn income. They have assets that generate income for them, even when they are not working. Assets are things that put money in your pocket, such as businesses, stocks, bonds, real estate, royalties, etc. On the other hand, the poor and the middle class work for money. They exchange their time and skills for money, and then they spend that money on expenses. Expenses are things that take money out of your pocket, such as bills, taxes, debts, rent, food, clothes, entertainment, etc. The problem with working for money is that you are always limited by your time and your income. You can only work so many hours a day, and you can only earn so much money per hour. And the more money you earn, the more taxes you pay, and the more expenses you have. This creates a cycle of working harder and harder, but never getting ahead. The solution is to break free from the cycle by building assets that can provide you with passive income. Passive income is money that you earn without working or with minimal work. This way, you can have more time and more money to do what you love and achieve financial freedom. For example, let's say you have a job that pays you 50,000 Indian rupees per month. You spend 40,000 Indian rupees on your expenses and you save 10,000 Indian rupees. If you invest that 10,000 Indian rupees in a business or a stock that pays you a 10% return per year, you will have an extra 1,000 Indian rupees of passive income per month. That means you can either spend more, save more, or invest more. And the more you invest, the more passive income you will have. Lesson 2. Why teach financial literacy? The second lesson is that you need to learn financial literacy. Financial literacy is the ability to understand how money works and how to make it work for you. It is not taught in schools, but it is essential for anyone who wants to be rich. Financial literacy includes topics such as accounting, investing, taxes, debt, inflation, risk, etc. These are not complicated or boring subjects, but rather tools that can help you make better financial decisions and grow your wealth. One of the most important concepts of financial literacy is the difference between assets and liabilities. As we mentioned before, assets are things that put money in your pocket, and liabilities are things that take money out of your pocket. The rich buy assets, and the poor and the middle class buy liabilities. For example, many people think that their house is an asset because it is worth a lot of money. But unless you are renting out your house or selling it for a profit, your house is actually a liability. Why? Because it costs you money every month to maintain it, pay the mortgage, the taxes, the insurance, the utilities, etc. And the more expensive your house is, the more money it takes out of your pocket. The same goes for cars, clothes, gadgets, and other things that people buy to impress others or to feel good. These are not assets, but liabilities. They do not make you richer, but poorer. The rich, on the other hand, buy assets that can pay for their liabilities. For example, instead of buying a fancy car with their own money, they might buy a rental property that generates enough income to pay for the car. This way, they have both the asset and the liability, but the asset pays for the liability. And they still have money left over. Lesson 3. Mind your own business. The third lesson is that you need to mind your own business. This does not mean that you should ignore other people's problems or be rude to them. It means that you should focus on building your own assets and not rely on your job or your employer to take care of you. Many people think that their job is their business and that they are working for themselves. But in reality, they are working for someone else's business and making someone else rich. Their job is not their asset, but their employer's asset. The rich don't work for others, they work for themselves. They create their own businesses or invest in other businesses that can generate income for them. They mind their own business and not someone else's business. For example, let's say you work as a software engineer for a big company. You might think that you are doing well because you have a high salary, a nice office, and a lot of benefits. But you are not minding your own business, you are minding your employer's business. Your employer is using your skills and your time to create software that can make them money. And if they decide to fire you, or replace you, or outsource your job, you will lose your income and your security. But if you create your own software or invest in a software company that can make money for you, you are minding your own business. You are using your skills and your time to create an asset that can generate income for you, regardless of what happens to your job. And if you succeed, you will have more income and more security than your employer. Lesson 4. The history of taxes and the power of corporations. The fourth lesson is that you need to understand the history of taxes and the power of corporations. Taxes and corporations are two of the biggest factors that affect your financial situation, and you need to know how to use them to your advantage. Taxes are payments that you make to the government for the services and benefits that they provide. Taxes are necessary for any society to function, but they can also be a burden for your wealth. The more money you make, the more taxes you pay, and the less money you keep. But taxes were not always like this. In fact, taxes were originally created to punish the rich, not the poor. In the past, most people were farmers or workers, and they did not pay any taxes. The only people who paid taxes were the landowners and the merchants, who were the rich and powerful. They paid taxes to the king or the government, who used the money to fund wars and other projects. But things changed after the Industrial Revolution, when factories and machines replaced farms and workers. The rich became richer and the poor became poorer. The rich used their money and influence to lobby the government to lower their taxes and to shift the tax burden to the poor. They also created corporations, which are legal entities that can own assets, make money, and pay taxes, but are separate from their owners. Corporations are very powerful because they can do things that individuals cannot. For example, they can raise money from investors, borrow money from banks, hire and fire employees, sue and be sued, and operate in multiple countries. They can also pay less taxes than individuals because they have more deductions, loopholes, and incentives. The rich use corporations to protect their assets, reduce their taxes, and increase their income. They don't own their assets directly, but through their corporations. They don't pay taxes on their income, but on their profits. And they don't work for money, but for shares. For example, let's say you own a corporation that makes 10 million Indian rupees per year. You pay yourself a salary of 1 million Indian rupees, and you pay 30% tax on it, which is 300,000 Indian rupees. You also pay 20% tax on your corporation's profit, which is 1,800,000 Indian rupees. So your total tax is 2,100,000 Indian rupees, and your net income is 6,900,000 Indian rupees. But if you don't own a corporation, and you make 10 million Indian rupees per year as an employee, you pay 40% tax on it, which is 4 million Indian rupees. So your net income is only 6 million Indian rupees. As you can see, owning a corporation can save you a lot of money in taxes. Thank you for listening.